Hi everybody, I'm back with Ryan from firmTRAK Accounting, and I'm joined today by both of our partners, Richard Marvel and Carin Weiss-Krolikowski. That aside, we were just taking a look at the one big bill here, and the standard deduction is changing for our current year that we're in right now, 2026, and it is increasing from the prior year, which was $30,000 for married filing jointly, and it's going up to $32,200. And then for single filers, it's increasing from $15,000 to $16,100. And then we were just kind of having a discussion here about how, as we near tax time, we're in mid-March, give or take, and what personal tax considerations people should consider when they're getting ready to file their 1040s on April 15th or 6 months after if you've extended. So Rich, kind of what did that kind of trigger for you when you're thinking about tax time and what people who own businesses are thinking about this time of year?
Ryan, I think from my perspective, I was thinking about this as it relates to business owners that maybe are not organized as an entity where they file separate taxes for their own business, versus those business owners that are operating on their own and showing their business income and losses on their Schedule C. And you know what I started to think about was, is there a line in the sand where it makes sense to go ahead and organize or not organize, considering the now standard deduction is so high? And which I think started the conversation. And then Carin, and you really brought out some really good points that kind of led us to the conclusion. And, you know, Carin, why don't you enlighten us on kind of where, or enlighten everybody else on how you enlighten me?
Well, I think that, you know, when you're looking at the different sections from a balance sheet, you're looking at overall income for a year and what you're going to end up filing at the end of the year for your previous year's taxes. We were discussing the difference or the benefits of either being a C Corp or an LLC with an S Corp election, or even just an S Corp. And it depends on your income. I'm sure there's a break-even number that looks right as far as any draw that you take is going to come out of equity, but that really doesn't give your company as a whole lot of benefits. Whereas if you have an S Corp election, you can, as Ryan liked to put it, statutorily take a reasonable salary, and then the company that you currently own can take the expense, plus you're having monies withheld for taxes as a W-2 earner instead of as a draw, where you're having personally to have to pay both sides of the unemployment tax, and there's no benefit for your company other than it lowers the equity in your company. So you're really better off to have some kind of a payroll system within your company. For instance, the three of us in our company, firmTRAK Solutions, we have W-2 earnings. So we set up as an LLC, but we took the S Corp elections so that we could pay ourselves reasonable amount of salary and get the benefit, which lowers your tax liability for your K-1. And then also it lowers the amount of liability tax-wise that you're going to have to carry individually. And if that doesn't make sense, it's because it's tax law, okay? That's why it doesn't make sense, but that is how it works. And Ryan, myself, we are happy to go over this with you and help you figure out what entity would be best for you for tax planning ahead. Ryan, what was your take?
Well, yeah, I think I would just like to add that Rich mentioned people who don't have an entity. And one of the other big things about forming an entity is liability protections, this is general knowledge that you can look up when forming your entities, but you are actually personally liable for any of your accidents, or a big thing in insurance is errors and omissions. You can be held personally liable if you don't form an entity. So even in spite of thinking about your overall tax liability, you should consider forming an entity explicitly for the liability protections and keeping that within the company's assets. And then another point Rich had mentioned, I think, was sort of thinking of things on the negative side. How do you kind of think about that, Rich, in terms of like tax liability and coming in with the standard deduction and a loss from your business potentially.
Well, I think that that's an interesting conversation because, you know, if you run a business and you're running as an organized, let's say you're an LLC, taxed as a subchapter S, and you acquire an asset where you have, you can do some sort of a asset assessment to determine what you can maybe accelerate depreciation on. I think that there's a scenario in which your business can be showing a loss despite an income if you do accelerated depreciation, and how that accelerated depreciation could potentially assist in offsetting some of your normal W-2 income that you would otherwise have to pay tax on. So I think that there are some potential uses that I can see that would be advantageous to have an organization purely for loss standpoints, but the goal would be to ultimately have income coming from these businesses. But I think that there's maybe a stacking effect that could be helpful in some situations.
Okay, well, that sort of finishes up the discussion for this week, I think. If you, as always, if you need more information or have any questions for us, come visit us at firmTRAK.com and leave a comment below, and we'll be happy to speak with you about any of your questions.